All right. Good morning, everybody. We continue with the employment numbers. Today it's unemployment, but still the entire week is employment numbers. We'll wrap up at the end of the week with non-farm payrolls. It's the biggest one. Get a gap close play opportunity. Yesterday, by the time we got to lunch, the market had enough positive vibes, turn everything to the upside. A lot of news articles out there promoting uh, or highlighting the outflows in some key ETFs and in the NASDAQ. So biggest outflows since 2008, I believe, what they were jumping up and down about. Small caps are down almost 0.5%. The Dow basically flat with the S&P. NASDAQ behind that. Japan up barely a quarter, with Europe closer to 0.5%. This ties in with a rate decision, or the anticipation of a rate decision from Europe. European Central Bank set to lower key rates by 25 basis points in June. That's got everybody all excited. Canada had their rate decision yesterday. Here's one of those odd time frames. You know, I say watch the clock. Half hour and the full hour are the two that you really want to watch, but there are some economic events that come out on the quarter of an hour. We're going to have an ECB press conference at 8:45. Starts on the quarter of an hour. It's going to be just a little odd. You know, we're used to that 8:30 move. Still, it kind of highlights today, be careful in that window from 8 to 9:30. There's a lot of reasons to be careful in that window. Treasuries opening, you know, the dollar moving. We get data out of Europe a lot in that window between 8 and 9:30. And then we get our own economic events a lot of times at 8:30. So it's just a dangerous window to play in. We are going to get some auctions today in the front end, get the 4-week. Going to get a little data out of Japan tonight, but I think we'll focus on that later in the afternoon. So for Europe, this is going to be kind of a big deal. This could be the first cut since 2009. We're looking at the ES here on a weekly time frame. There's two places really you could do the fib. Leave it back at our old high. Measure it to the pullback bottom. This will project what price has done since then on this turnaround and this move back up. It allows you to monitor that 111 warning center and the 1236 target. You can do it this way, which is the way I really like to do it. But if you wanted to, you could just set it to where we're at now and add the 786. Setting your fibs this way would be more of a focus on just this move here and monitoring this pullback for the continuation. It might seem like we'd have the same fib set here, but we really don't. There's a reason that we had it on this side, which is monitoring what all of this is doing for that breakout and really not focusing on that 786, although you could. Doing it this way is really just focusing on this and is not worried about any of that. Not right or wrong, really. It's just what are you trying to quantify. We are at that 111. It's what I call the warning center for a reason. When we get breakouts, oftentimes it'll fade back. It'd be like a fake breakout and it doesn't sustain. When we get those fake breakouts, a lot of times it'll stall around that 111. So when we get that and it happens, we have that 786 to see if the pullback is just a pullback. We're right back to that level again. I wouldn't worry about the ticks here. Just call it 53.75 for a nice round number. We got to get above that and preferably close above it. This is a weekly though, so gives us a little bit of latitude. Put it on the daily. It's not so clean. Still kind of highlights the situation that we're in. This candle with all of that wick there implies that there was a lot of liquidity and a lot of selling up here, and we weren't able to get through it. We weren't able to absorb it all in that one shot. Then yesterday, when we ran up into that same level again and we closed there, and so far we're holding it, we're still not seeing that selling. It's very likely that we've taken out the rest of that liquidity, but we still need to deal with the 111. So we want to get above that, close above it, and continue that move to the 1236. If we reject here again, since we did set a new high here past this high, that does count for something. But we would want more than this. We only got a new high by a couple of ticks. We want more than that. So even if we do fade off, we got some technical analysis that we could point to and say we got a higher high. And it's actually one that, you know, had some meat on it. Right now we've got a higher high and it's just an overshoot, couple ticks. That's not very good. So 53.75 is a level to keep your eye on. And once we're above it, we want to see it act as a potential support. But until we do get above it, we want to consider it as a significant resistance. You can see we're pretty much balanced in between the ADR levels, and that makes sense because we're flat. We haven't done anything today. We haven't gone anywhere. We're up 1 point from where we opened in the Globex, so we really haven't done anything. We would be looking for edge to come into the open closer to one of these red lines, one side or the other. That would give us an implication that we would go to the line that we're closest to. Since we're starting in the middle, we don't have that. One thing that we can do is just measure what we do have. Globex high to Globex low. That gives us levels in each direction. So if we're looking for a breakout and a continuation, we've got our levels to the upside. That gets us up to the ADR. And if we break our own Globx low, then we'll focus on the lower ADR level by level by level. I used to think, after a really big day like we had yesterday, that we wouldn't get a second really big day. Technically, we don't normally get that sort of day by day behavior, but it doesn't mean that we can't. And that's important to realize, that when it comes to odds and statistics and probabilities, we don't normally get repeated big days 2 or 3 times in a row, but it can happen. There's 3 very large days in a row. I didn't have to look that hard for it. So while yesterday was a big day, had a really nice move to it, that does not mean that we can't do the same thing again today. So just something to kind of keep in mind. I bring this up because I know people that are they're just perma faders. Every time the market makes a move in one direction, they're constantly asking, hey, can we go the other way yet? Yesterday I had numbers of people reaching out asking, when can we short this? When can we short this? Has it done yet? You think it's going to roll over here? Now, sure, in the later part of the day, even I was looking for a rollover up here. So I started to consider, why would we not roll over? If you think about those VC funds and CTAs, those non-discretionary firms, at least the VC funds, which just use that for a moment. During this move up, the VIX falling out like it did, very likely triggered new VC fund levels that needed to be bought up. They're non-discretionary. They don't get to choose. They're almost always buying at the highs and selling at the lows. They're responding to what the VIX is doing, and their rules tell them to buy here, sell there. They don't get a say in it. So that would be one group that would be trading in the later part of the day, say during the MOC area, just adding to the buying, keeping us from selling off and doing that rounded reversal into the close. So today's central pivot is completely outside of the previous day's pivot. We've had layered pivots, layer pivot channels all week. This is the first day this week where they're not touching. We really want to consider where price is going to open up this morning. We are going to get econ before the open, so we could be closer to the red line. This red line is not the same red line that we were talking about earlier. This is an R1 level. Got the S1 down here. Like I was talking about yesterday, we want to see where we open. If we open above that R1, we can consider it a support. It's not a major support, especially if we open really close to it. And that means that we can fade back towards the pivot. We are completely dominant on the upside away from this weekly pivot as well. Now, I've tried to quantify how far away from that weekly pivot is too far. How far before we start looking for mean reversion plays? And I built an indicator to measure how far the ES gets from the weekly pivot before we see those reversals. And I thought that would be really insightful. Like, it would bring something to the table. It didn't. There really was no value to it. But it is something that I continue to keep my eye on. When we get too far away from that weekly pivot, we do stall out. Problem is, have not yet been able to quantify how far is too far. We can see on this week here that we got a considerable distance away, and then it went even farther, and then it went even farther again. So yeah, I mean, finally, eventually it did mean revert and came, really close to the weekly pivot again by the time it was done. But we got a significant distance away. And every time it looked like maybe that was as far as it was going to go, it went even farther and then even farther still. So on this move to the upside, if we think about how far away from the weekly pivot we are, it's not really all that far yet. I think we could move more and it still wouldn't be considered too far from that weekly pivot. But that's vague, and I don't really have a good number for how far is too far. We are in low volume this morning, which makes sense because we're really not going anywhere, just kind of chopping about. I got to put the spot gamma levels in here. I put it on the other computer, but not this one. Make sure these call walls and put walls haven't moved. I don't have the AM edition yet on the Spot Gamma Founders note. They were running a little behind this morning. So we're still above the volatility triggers, still above 0 gamma. The put wall still at 51.11. I would like to have seen that rolled up. That would be a bullish behavior to see that roll. We don't got it, but it would have been nice. And the call wall 54.14, or on the SPX 5400. We don't have a hedging this morning. We just have a lack of participation. We can see that looking at 59. Now, if we were to get below, I really like it below 60, but below, say, 50, it starts to be a little concerning. This volume that we're looking at down here, this is cumulative volume that starts at midnight. I came across this indicator a couple of years back, and I started using it trying to gauge what the average overnight participation looks like. I didn't know what I would get out of that at the time. I just wanted to try to get a feel for what does an average overnight look like, in participation point of view. So I started watching it. And of course, if you look at it every day for 9 months to a year, you start to get familiar with what the normal looks like. So there's no magic to this number. It's just getting a feel for the average, keeping track of what we've been getting, and being able to look back at what we've done over the last, few days, few weeks, however much I want to look back. Just trying to gauge how much activity there was. Did we get a big move on low volume? Did we get a little move on a lot of volume? Are we stalling out, hitting an iceberg? All that kind of good stuff. But it's just perspective. And the perspective this morning is that the volume is light, but they're not hedging. So they're not concerned enough to spend money to protect their positions. They're just sitting out waiting on news. 10-day, 30-minute volume profile with the TPO in blue. We made it through that point of control, which gave it a little bit of juice, a little bit of volume there, which added to the volume we already had. We're still not going to see that point of control move anytime soon. We're going to need to wipe out all of this volume through this zone before we start to see this volume reduce. So the only way this point of control is going to move anytime soon is if we start getting a lot of volume across this high here. Now that's absolutely possible to do, and it would be a really big heads up. It would tell us, that we've hit this ceiling and that we're still absorbing a lot of liquidity and a lot more orders and more and more and more building up there. We don't have that yet. We don't really have very much at this point. We want to look for high value, high volume nodes like this one down here. So we're starting to build it out a little bit. This will be cleaner after we get through this week, after we get through Friday, because all of this will be gone at that point, and the only volume at this level will be what we did here. That'll give us a clearer picture of what we've got up here. Now, of course, we don't need to wait that long. We can just come over to the 5x5. We got a pretty good idea of the level of volume that we hit. Look at yesterday. Where's the point of control from yesterday? It's up here at the top. Now, the new day has already begun. We've already got TPO for the Globex. But if we had TPO from last night, from yesterday, we would be able to see this. So, little trick. We'll just turn off the Globex. Now we can see that TPO from yesterday. The volume that we were getting between 2 and 3 yesterday is the point of control. It's also where the TPO is at for its point of control. And then we had a significant level of volume above that. Not enough to trigger the point of control to move up to this level, but pretty close. And that was done in what, 4 bars, 20 minutes, a half hour at most. We spent almost an hour here and built the point of control. We almost got a new point of control here in 30 minutes, half the time. So just put those two together. This is a lot of volume at the high of yesterday. We really need to keep above that level, and we can consider it an entire zone. We've got a high value node, high volume node at this 5360 area, and then everything up here. Now, we could differentiate between them. Our own Globex low kind of highlights this top one. If we break that Globex low, then we've got this bottom one. Or we can just put everything into one box. And consider this entire range a high value, high volume node. I think the line in the sand is going to be this 55 or 57. If we break that, we're very likely going to retrace back down to this other high volume node, 5340. And then if we break that, we can come back down to the VPOC. Well, that won't be there, right? Because we went through that yesterday. We cut through it. 5325 or 5320. It's the value area low, that yellow line there. You can see in the move yesterday, when we paused here, built out a lot of volume. And then when we ran up into 2 o'clock, built out a lot of volume. And then one more shot into 3 o'clock, built out that volume. It really does show up better here when I leave the Globex on, because we can see this area. That's where the greatest amount of volume happened. 4 o'clock, we have a candle up there at 4. At 4:15, everything changes for Globex. And that hour between 4 and 5, that's where our point of control is. If I turn that off, our point of control comes down to here. A lot of volume against the high of the day. We are inside week breakout, but only from a very minute amount. The thing is, it doesn't matter how minute it is, we're outside of the box. We're supposed to close inside this box at the end of the week. So Friday at 4, we should be inside this box. 80% of the time for the S&P, although this is a 1 standard deviation box, and that is a 70% number. Either way, whether it's a 70% number or not, the S&P lately has been closing outside this box more than it should, which is a warning all on its own. There's been times throughout history, if you look at, there was Volmageddon, there was there was a paper play, some kind of yield issue. COVID was another one. There's been times throughout history where we had warnings in advance that something was wrong. The S&P was consistently closing outside this box on a Friday, right before significant changes to the market. So we kind of want to see this rebuild its record, its track record. The only way it can do that is week after week closing inside the box. Last week, for an example, we got out of the box, we came back in. We closed inside by the end of the week. But back here in May, we had 2 weeks in a row where we closed outside the box. So, 2 weeks of failing to do what it's supposed to, 2 weeks of doing what it's supposed to, and now this week we're outside again. We need better numbers than that. So keep your eye on it, 53.60. It's the weekly expected move high. Oftentimes we'll pin there in a lower volatility environment. And I know, I get it. If you look at the VIX, it's low, but that's not necessarily the volatility that I'm looking at. Volatility is another word for movement. It's just the geek word or the nerd word for movement. So if we want a lower volatility environment, we want a lower environment where price isn't making these big, sweeping, drastic moves. We are 2.25% above the 10-week. We're just getting started. The nice sweet spot is generally between 2 and 3. Above 3 is fine. You can see when I scroll out farther, put my mouse at 3. We've spent plenty of time greater than 3% away from the 10-week. That doesn't make us overbought at all. Now, that's a big picture point of view. We kind of want to look at what happened yesterday and ask, did we move too far yesterday? Are we overbought? Are we due for a pullback? So how far away from the 10-day we are really kind of helps us quantify that question. If we look back at where we reverse when we get too far away from the 10-day moving average, it's closer to 2%. Getting beyond 2% away from the 10-day moving average really starts to highlight reversals. The thing is, we don't have to reverse. We can just pause, and within a few days, without going any farther higher or lower, the 10-day will come to us. So these reversals, they don't have to necessarily mean that price turned around and fell back to the 10. They could just mean that we stalled out and we let the 10 come to us. Either way, we're not even 1% away from the 10-day yet. We're close, but we're not even that far. So in that quote big move from yesterday, are we overbought? Have we moved too far or too fast? And does it owe us a pullback? No. There's no reason to look for mean reversion, least squared methods, dot plot statistics, or anything else that says we went too fast and too far and we need to turn around and pull back. Not yet. It doesn't owe us one. The 10-year did an inside day breakout in the Globex for a brief moment and rallied back up. We're back above 4.3. Crude inside day breakout to the upside, Buzzbeat. It's still holding that breakout to the upside. Gold, really nice move up, but now it's washing it back out. More of like a gap close than anything else. The dollar is already above the halfback from yesterday after it broke out. Inside day breakout to the downside, came back in. Now it's above the halfback. So a line in the sand. We kind of want to see things just calm down. We don't want big sweeping moves out of the dollar or the 10-year. And if we do see big moves in those, we'd rather see it moving to the downside rather than the upside. Those yields are basically the only thing that we have down at the moment. When we look at what's up, semiconductors, I mean, that's not much of a surprise. Uranium, the FANGs, biotech's kind of balancing on the line. It's not quite there, but it's close. And really, I mean, that's it. We got uranium and semiconductors and nat gas, but I mean, it's nat gas. That's not carrying the market. Nothing else is high enough to meet our qualifications. This says construction is up this morning too, through ITB, but you can see it's just a print, right? That 106.57, a little algo dot up there. That's it. So technically it is up, but we would want to see some flows with it, right? Otherwise, I mean, it could be like a dark pool print or something. Be 100 different things that could cause that up there. One little print, that's not enough. We got silver up this morning. That wasn't showing up on Thinkorswim either for some reason. I never question it. I just know not to trust it. That's why we use multiple sources. So a little pop up in silver, but we haven't done anything with it yet. And we do have a significant resistance level halfway through this zone. So 28.20, you can round up, say 28.25, especially if you move this print over to this previous point here, it makes sense to use that anyways. That's 28.25 right there. Spot on, right on the quarter. Semiconductors also up this morning. It's getting a little janky. That was a significant gap down and then a rally back up. It's a very large candle from yesterday. One of the things that we can do if we do fade back down into yesterday's price, mark that candle out, give us the 50% mark. Now you can add that 786. It won't hurt anything to do that, right? And it kind of helps us gauge the level of the pullback that we're looking at. I'm just going to use this this level here. That would be 252.93. Call it 254 for SMH. Really want to see it hold above that 254. Because then that would just be a pullback as part of a continuation. A little bit of a scoop. Breaking below that, we'll challenge this previous high. Call it 251. Break that, challenge the half back, and then back down. This entire candle pattern is what I refer to as a TRB setup, trendline breakover. I love this setup. You can find it all over the place. And when you get that candle going, this candle right there, the reason I like the TRB setup so much is however deep this is, on the day that you start to get the breakover, the target is at least to the top. And that means that you get this really big candle. As a day trader, that really big candle is the one that I'm hunting for, especially with options. But this TRB setup, a lot of times will have a better base built down here and then the breakover so that you have, like an IX10 down here or something like that. We didn't really get that with silver, but still, this is a great TRB setup to study. Crude is up, more of a reflexive bounce than anything else. I don't see this rallying back out again, not yet. Could look at it through crude or U.S. oil if we want to. Still, this was a significant fall from grace, and we're just getting a little bit of a bounce. So we could consider measuring that entire megaphone pattern and then projecting the move to the downside. But if you've gone through any sort of candle books or technical analysis classes or anything like that, what it tells you is measure the event, the range, the candle, whatever, measure its highest point to its lowest point, so the broadest part of that range, and then project those levels to the downside, 50% and 100%. It already made that move, and it's coming back up. Now we can just leave the levels in place. The last low that was made before the breakdown, that would be our line in the sand. Really don't want to see it get past that level. Just to kind of clean some lines up here. So 76. We don't want to see it get back above that. We want to see it fulfill this move to the downside, which should get us back down into that 68 area. The numbers are different on USO, but the setup isn't. It was still a megaphone pattern and a breakdown. So gold miners, precious metals, semiconductors. It's good that we're seeing things starting to broaden out a little bit, but we would want to see, the Mag 7, some junior tech, some older tech, maybe some China ADRs. We're not seeing K-Web up here, not seeing communications, consumer discretionary. Those are what we're going to want to see. So Apple, lots of trash on that 30-minute chart, lots of resistance to deal with around that 96.5. We got the breakout this week, but we're just stalled. That's a really big candle, and we closed underneath the halfway point. Then we had yesterday where we really didn't do much. So we're testing and holding that half back level. It's not exactly inspiring there. Amazon trying to get an inside breakout this morning. It's trying. Now this is a really big TRB. Really big. I doubt that it's going to make a $10 move all the way back up to the top like we were talking about on silver with the TRB. You got to just, recognize the distance and the range here. That's too big to make in a single shot. But as a TRB, that is setting up really nice. Maybe on a different time frame, like a weekly. That would put us around 190. Microsoft, another one that stalled out this morning, really not getting that breakout, that continuation. Big move from yesterday. It finally got out of this range, but that wasn't a compressed, tight range to begin with. We want to mark yesterday's level, look for that fade back to the halfback. We can just put a 786 on there and make sure if it is going to continue as a trend that it stays above that 422.5, 786 level. Continuation in NVIDIA, even after that big move. All right, blue skies are no different than anything else. We can still just measure the last range, the last pullback. 1247, easy level. Which we got to in the pre-market. You can see now here on the intraday. So it closed here at this 1224, and we're already at 1248. So we've hit that 200. That's its next pause point. It doesn't mean it's going to sell off from there. It just means that's where we expect it to digest and pause. So we do have that stock split coming up on the 10th, next Monday. You remember when Apple and Tesla and all them, Google, when they did that stock split and people just bought it like crazy all the way up into the split. And then it, kind of dumped, sold out afterwards. Well, that's just some ugly trash there. The interesting perspective when you put it on the monthly, we can clearly see these lower highs, but we're starting to see these higher lows here as well. So forming a compression, building up for another big move. Doesn't really imply direction, right? Just implies a big move. When we look at this double bottom that we have here, make sure it was behaving correctly. Didn't exceed the 111, came back up. We could retest that. We see it all the time, right? Where we get the 111 fake out, comes back up, and yet it comes back down and tests against the 100 again before it continues. But I wouldn't want to see this cut below 140. Really, it shouldn't get back below 150. If this recovery is intact, then it shouldn't cut below 150. That might not seem very helpful. It's 15 points away. But I wanted to bring it up because this low here is not going to be the end of the move, or it didn't have to be the end of the move. Let's say it that way. But this is still a beat down trash. You can see that. Just put on your R line, put your chart on a 1 year, and just move your mouse from left to right. You can see it doesn't matter if I'm below, above or below, just left to right. But think that's very clear. So watch the clock today. See if we can keep this sentiment in place. We're going to look for a continuation of the money flows. If we want to see some better sectors, right? Right now, we don't really have the sectors that we would want to see. Depending on if you've got Thinkorswim or not, you can go to the Visualize tab, change the heat map. You don't need this. Go to the Index Watch. These are detachable, so you can load more than one. Just scrunch it down. It doesn't need to take very much space. This is an advanced decline line with money flow. So just put the capital over there. Choose your index. Thinkorswim offers you watch lists for the S&P 100, for an example. Or the NASDAQ 100. So as an advanced decline line, just keep track of this today. If we're going to stay bullish, we're going to need that participation. We want to see a good 60 to 70% moving to the upside and more money coming in than going out. Obviously, the more names to the upside, the better. So if we can get, 85 or 90% of the S&P 100 and the S&P, the NASDAQ 100 moving to the upside, that would be even better. But a lot of times it doesn't have to be that clear or that significant, and we still get good rallies. You can also do that for a Mag 7 list, right? Just make your own watch list, put the Mag 7 in it, load it into one of these, and then you can see the money flow in the Mag 7. Because, of course, whatever they're doing, that's what the rest of the market's going to do. All right, so watch the clock, watch the money. Be careful, guys. I will see you all tomorrow.